What if the warning signs we're seeing right now feel uncomfortably familiar? Across the United States, certain housing markets are experiencing price drops that are happening faster than many experts expected. While this is not a repeat of 2010, the speed of the shift has caught the attention of buyers, sellers, and homeowners alike. In some cities, home prices are cooling so quickly that longtime residents are starting to ask serious questions about what comes next. The first hook is simple but powerful. Housing markets don't change direction this fast unless something bigger is happening underneath. For years, prices surged almost nonstop, driven by low interest rates, remote work trends, and limited inventory. But now conditions have shifted. Higher borrowing costs, affordability pressure, and changing buyer behavior are reshaping local markets, and not every city is handling the adjustment well. Another reason this moment feels different is how uneven the changes are. While some cities remain relatively stable, others are seeing listings sit longer, price cuts become more common, and demand soften rapidly. These shifts don't always make national headlines, but at the local level, they're impossible to ignore. In certain U.S. cities, prices are adjusting downward faster than they did during early stages of the last major housing correction, even if the overall situation is not identical. It's important to clarify what crashing really means in today's context. This does not automatically mean a total market collapse or a repeat of past financial crises. Instead, it refers to rapid price corrections following years of aggressive growth. In many cases, prices surged far beyond what local incomes could support. When affordability reached a breaking point, demand slowed, and prices began to fall quickly to rebalance the market. One major factor driving these changes is interest rates. As mortgage rates increased, monthly payments rose sharply, even for modest homes. Buyers who could once afford a certain price range suddenly found themselves priced out. This shift happened quickly, and in cities where prices were already stretched, the impact was immediate. Sellers in those markets are now competing for a smaller pool of qualified buyers, leading to faster and deeper price reductions. Another contributing factor is inventory. During the boom years, many homeowners delayed selling, either because they had locked in low mortgage rates or expected prices to keep rising. As market conditions changed, more listings began to appear at the same time demand weakened. In cities where new construction was already high, this added pressure caused prices to adjust downward more rapidly than anticipated. Investor activity also plays a role in how fast prices change. Cities that attracted a high number of short-term investors or speculative buyers during the peak years tend to be more vulnerable during corrections. When expectations shift, these investors are often quicker to sell, increasing supply and accelerating price declines. This doesn't mean the city is failing, but it does mean the market is repricing itself at a faster pace. Economic conditions at the local level matter just as much as national trends. Cities that rely heavily on a single industry or experience sudden population growth during the boom are now adjusting to new realities. If job growth slows or remote work patterns change, housing demand can shift quickly. Markets that expanded too fast are often the ones that cool the fastest. What makes this moment especially important is timing. Many buyers are watching closely, unsure whether prices will stabilize or continue to fall. Sellers are facing decisions they didn't expect to make, including price reductions or waiting longer to sell. For homeowners, these changes can feel unsettling, even if long-term fundamentals remain strong. This video is not about fear or predictions of financial disaster. It's about understanding where and why prices are changing faster than expected. Housing markets move in cycles, and recognizing early signals helps people make more informed decisions. Some cities are simply correcting after extraordinary growth, while others may face longer adjustments. As we move forward, we'll take a closer look at specific U.S. cities where price declines are happening faster than many people realize. Each case tells a different story, shaped by local economics, migration patterns, and market behavior. Understanding these stories provides valuable insight into where the housing market may be heading next. Some housing markets slow down quietly, but others reverse direction so fast that even longtime residents feel caught off guard. In several U.S. cities, home prices are declining at a pace that feels sudden after years of rapid growth. These cities didn't necessarily collapse overnight, but the speed of the adjustment is what's raising eyebrows. When prices rise too far, too fast, the correction often comes just as quickly. One major hook to understand is this. Cities that experience the strongest price booms are often the most vulnerable during a cool down. Markets that saw double-digit annual growth attracted buyers willing to stretch budgets, investors chasing appreciation, and builders racing to add supply. Once affordability weakened, those same markets were exposed to faster reversals. Price declines in these cities are not random. They follow a pattern rooted in rapid expansion. Sun Belt cities are among the most closely watched right now. Many of these locations saw explosive growth as people relocated for warmer weather, lower taxes, and remote work flexibility. As demand surged, prices climbed quickly. But as interest rates rose and migration slowed, buyer demand cooled sharply. In several Sun Belt metros, listings began piling up while sellers started reducing prices to attract attention. The result has been faster than expected price drops in certain neighborhoods. Another category of cities seeing sharp declines includes those with heavy new construction. During the boom, builders responded aggressively to demand, adding thousands of new homes and apartments. When buyer activity slowed, that supply didn't disappear. In some cities, new developments are now competing directly with existing homes, forcing sellers to lower prices to stay competitive. This oversupply effect can accelerate price declines even when the broader economy remains stable. Tech-driven cities have also felt pressure. Markets that benefited from high-income job growth during the remote work surge are now adjusting to changing employment patterns. Hiring slowdowns, return-to-office policies, and workforce shifts have cooled demand in areas that once felt unstoppable. When fewer high-income buyers are competing for homes, prices often adjust quickly, especially in neighborhoods that experience the steepest appreciation. Investor-heavy markets are another group experiencing faster price corrections. In cities where a significant portion of homes were purchased as rentals or short-term investments, price stability depends heavily on expectations. When rent growth slows or financing becomes more expensive, investors may reassess their positions. Increased selling activity from this group can add supply to the market quickly, putting downward pressure on prices. Some Midwest and interior markets are also showing signs of rapid adjustment, though for different reasons. These cities may not have experienced dramatic price booms, but affordability limits still matter. When wages don't keep pace with housing costs, even modest price increases can suppress demand. As buyers step back, sellers are forced to adjust expectations, sometimes leading to noticeable price drops in a relatively short period. Local economic conditions play a critical role in how fast prices change. Cities tied closely to industries experiencing volatility, such as logistics, manufacturing, or tourism, can see housing demand shift rapidly. Even small changes in employment outlook can influence buyer confidence. When uncertainty rises, buyers pause, and markets with less diversified economies feel the impact sooner. Another important factor is buyer psychology. After years of hearing that prices only go up, even small declines can change behavior. Buyers become more cautious, waiting to see if prices fall further. This hesitation can slow sales activity, forcing sellers to cut prices more aggressively to close deals. In cities where sentiment shifts quickly, price declines can accelerate beyond what fundamentals alone would suggest. It's crucial to emphasize that falling prices do not automatically mean a city is failing or unlivable. In many cases, these adjustments are part of a healthy market reset. Prices that rose beyond sustainable levels are correcting to better match local incomes and demand. For long-term residents, this can eventually improve affordability and stability. As we continue this series, we'll look deeper into why some cities adjust faster than others and what these changes mean for homeowners, buyers, and renters. Each city story is shaped by unique combinations of growth, supply, and economic forces. Understanding these dynamics helps separate panic from perspective. When home prices fall faster in some cities than others, it's rarely due to a single cause. The most vulnerable housing markets usually share a combination of economic, demographic, and structural factors that amplify change. Understanding these factors helps explain why certain cities are adjusting at a speed that feels alarming, even if the broader housing system remains intact. The first key vulnerability is extreme affordability strain. In many of the cities experiencing the fastest price declines, home values climb far beyond what local wages could reasonably support. During the boom years, buyers relied on low interest rates to stretch purchasing power. Once borrowing costs rose, the math stopped working. Monthly payments increased dramatically, and demand dropped almost overnight. Markets that relied heavily on stretch buyers tend to reverse direction quickly once affordability breaks down. Another major vulnerability is rapid population inflow, followed by sudden slowing. Cities that experienced massive growth due to remote work, relocation trends, or lifestyle migration saw demand spike quickly. Housing construction followed, often aggressively. When migration slowed or reversed, those cities were left with more supply than demand could absorb. This imbalance creates downward pressure on prices, especially when sellers compete for fewer active buyers. New construction volume plays a powerful role in how quickly prices adjust. Cities that added large numbers of homes, apartments, or subdivisions during the peak years now face increased competition among sellers. Builders may offer incentives or price reductions to move inventory, forcing existing homeowners to respond. This chain reaction can accelerate declines, even if the city's long-term outlook remains positive. Investor concentration is another important factor. In markets where a significant share of homes were purchased as investments, price stability often depends on expectations of appreciation. When those expectations change, investor behavior changes quickly. Some choose to sell rather than hold, adding supply to the market. This does not mean investors are panicking, but it does mean that markets with high investor activity can shift faster than owner-occupied communities. Economic diversity also matters. Cities with economies heavily dependent on one or two industries are more exposed to sudden shifts. If hiring slows, wages stagnate, or job growth becomes uncertain, housing demand can weaken rapidly. Buyers tend to hesitate in times of uncertainty, and hesitation alone can slow sales enough to force price adjustments. Another vulnerability is buyer sentiment. Housing markets are influenced not only by numbers, but by confidence. When buyers believe prices may fall further, they wait. This waiting reduces competition and weakens negotiating power for sellers. In cities where sentiment turns quickly, price declines can outpace economic fundamentals, at least temporarily. Tax and insurance costs can also accelerate price adjustments. In some cities, rising property taxes, insurance premiums, or maintenance costs have made ownership less attractive. These added expenses increase the true cost of owning a home, pushing some buyers out of the market. Sellers in these areas may face additional pressure to lower prices to compensate. Local policy decisions and zoning rules can influence how markets adjust as well. Changes in development regulations, rental policies, or property taxes can affect investor interest and buyer demand. While these factors rarely act alone, they can contribute to faster price movement when combined with other pressures. It's important to separate vulnerability from collapse. A city experiencing rapid price declines is not necessarily in long-term trouble. In many cases, these markets are simply correcting after extraordinary growth. Price resets can restore balance, improve affordability, and create healthier conditions over time. The speed of the adjustment may feel dramatic, but speed alone does not define long-term outcomes. What makes this period particularly interesting is how transparent the signals are. Longer listing times, frequent price cuts, reduced bidding competition, and increased incentives are all signs of markets recalibrating. These signals are more visible now than in past cycles due to online listings and real-time data access. Observing them helps buyers and sellers make informed decisions rather than reacting emotionally. As we move forward, understanding vulnerability helps explain not just where prices are falling, but why. Each city's situation is shaped by its own mix of growth patterns, economic conditions, and buyer behavior. Recognizing these factors allows viewers to approach housing market news with clarity rather than fear. When home prices begin falling quickly in certain cities, the impact is not the same for everyone. Homeowners, buyers, and renters all experience these changes differently, and understanding those differences is crucial. While headlines may focus on price drops alone, the real story lies in how shifting markets reshape decisions, expectations, and financial planning for everyday people. For homeowners, falling prices can trigger uncertainty, especially for those who purchased near recent highs. One major concern is home equity. When prices decline, equity growth slows or temporarily reverses, which can feel discouraging. However, this only becomes a serious issue for homeowners who need to sell in the short term. Long-term owners who plan to stay put are often less affected, as market cycles tend to even out over time. For many homeowners, monthly affordability and job stability matter more than short-term price movement. Another key factor for homeowners is mindset. During fast-rising markets, expectations shift toward constant appreciation. When prices cool, that psychological adjustment can be uncomfortable. Sellers may initially resist lowering prices, leading to longer listing times. Over time, markets usually find balance as expectations reset. This phase is not unusual. It's part of how housing markets correct after periods of rapid growth. Buyers, on the other hand, often see falling prices as opportunity, but timing matters. In cities where prices are adjusting quickly, buyers gain leverage. Fewer bidding wars, more negotiation room, and increased seller incentives become common. However, buyers also tend to hesitate when prices are declining, worried about purchasing too early. This hesitation can slow transactions further, extending the correction phase. Affordability remains the central issue for buyers. Even with lower prices, higher interest rates can keep monthly payments elevated. In some cases, price drops help offset borrowing costs, bringing monthly payments closer to sustainable levels. Buyers who focus on long-term affordability rather than short-term price movements are often better positioned to navigate these conditions calmly. Renters experience market changes differently. In some cities where home prices are falling, rental markets also begin to cool. Increased housing supply and reduced investor demand can ease pressure on rents. While this does not guarantee immediate rent reductions, it can slow rent growth and improve availability. For renters considering buying, these shifts may open doors that were previously closed. Investor behavior also influences all three groups. As some investors exit cooling markets, inventory increases, affecting prices and rental availability. This can benefit buyers and renters, but may create competition for homeowners trying to sell. Markets with balanced investor participation tend to adjust more smoothly than those heavily driven by speculation. Another important consideration is mobility. Homeowners in declining markets may delay moving, especially if selling would mean accepting a lower price than expected. This reduced mobility can impact job decisions and lifestyle changes. Buyers, meanwhile, may expand their search areas, considering cities that were previously too expensive. Renters often gain flexibility during these periods, as landlords work harder to retain tenants. It's also important to address fear versus reality. Falling prices do not automatically signal financial danger for everyone involved. Housing markets fluctuate, and corrections are a normal part of long-term trends. Many homeowners weather price declines without issue, particularly if they maintain stable employment and manageable mortgage payments. Buyers who plan to stay long-term often benefit from entering the market during calmer periods rather than competitive peaks. Policy and lending standards today differ significantly from past downturns. Lending practices are generally more conservative, and most homeowners have stronger equity positions than during previous housing crises. This reduces the likelihood of widespread distress, even in cities experiencing faster price drops. Context matters when interpreting market shifts. For all groups, information and planning are key. Understanding local conditions, tracking trends rather than headlines, and making decisions based on personal circumstances help reduce stress. Housing is not just an investment. It's a place to live. Markets adjust, but daily life continues. As prices reset in certain cities, opportunities and challenges emerge simultaneously. The key is perspective. Market changes reward patience, preparation, and realistic expectations rather than emotional reactions. Housing markets don't move in straight lines, and moments like this often feel more dramatic while they're happening than they appear in hindsight. The cities experiencing fast price drops today are not necessarily headed for permanent decline. Instead, many are going through a recalibration after years of unusually rapid growth. Understanding what to watch next helps separate short-term noise from long-term reality. One of the most important signals to monitor is price stabilization. When price cuts become smaller and less frequent, markets often begin finding their footing. This doesn't mean prices immediately rise again, but it does suggest that buyers and sellers are starting to agree on value. In cities where prices fell quickly, stabilization is often the first sign that the correction phase is nearing its end. Another key factor is inventory levels. If new listings continue to rise while demand remains soft, price pressure can persist. However, if inventory begins to level off or decline, it may indicate that sellers are adjusting expectations or waiting for more favorable conditions. Balanced inventory tends to support more stable pricing over time. Employment trends also play a major role in long-term outcomes. Cities with steady job growth, diverse industries, and strong regional economies tend to recover more smoothly. Even if prices fall quickly, solid employment fundamentals often prevent declines. Watching local job data provides valuable context beyond housing headlines. Interest rates remain a critical wild card. Changes in borrowing costs directly affect affordability and buyer behavior. Even small shifts in rates can influence demand, especially in markets that experience sharp corrections. While no one can predict rate movements with certainty, understanding their impact helps explain why markets behave the way they do. It's also important to recognize how expectations evolve. During booming markets, optimism often runs high. During corrections, caution takes over. Over time, expectations usually settle somewhere in the middle. This psychological reset is a normal part of market cycles and often leads to healthier, more sustainable conditions. For buyers, these periods can offer opportunity, but only when paired with patience and preparation. Entering a cooling market with realistic expectations, stable finances, and long-term plans reduces risk. Buyers focused solely on short-term price movement often miss the bigger picture, while those focused on long-term affordability tend to navigate transitions more confidently. For homeowners, the key takeaway is resilience. Short-term price fluctuations matter far less than long-term stability and affordability. Homeownership is a long game, and markets have historically moved through cycles of growth, correction, and recovery. Maintaining manageable payments and financial flexibility often matters more than market timing. Renters watching these changes may gain leverage as markets adjust. Slower rent growth, increased availability, and more options can improve flexibility. For those considering buying, corrections may expand possibilities that were previously out of reach, though careful evaluation remains essential. What makes this moment different from past housing downturns is context. Lending standards are stronger, homeowner equity is generally higher, and the broader financial system is more regulated. While challenges exist, the conditions that fueled past crises are not identical today. That distinction matters when assessing risk. Ultimately, the cities where home prices are falling fastest are not simply stories of decline. They're lessons in how markets respond to imbalance. Rapid growth creates vulnerability, and corrections restore balance. Neither phase lasts forever. The biggest takeaway is clarity. Housing markets are local, cyclical, and influenced by many moving parts. Understanding why prices change helps viewers stay informed without being driven by fear. Whether prices rise, fall, or stabilize next, knowledge remains the most valuable asset.